Good afternoon and welcome back to the latest edition on the InvestTalk market analysis for the week ending March 29th, 2024. And it's the end of the quarter, and that's why I'm titling this video Q1 ends with a bullish tone, but is a sell off near. And I'll get to that in a bit, but let's get to the economic news. And it was a busy week. You had Monday, new single family homes sold. That did tick down a little bit on the month, but still really in an uptrend since last summer, and at a robust level, especially considering underlying sales of homes in general, existing homes. And so the new home market continues to be a place of uh, a higher percentage of activity compared to that existing home market. So that remains fairly strong. Durable goods orders month over month that did have a nice rebound after a couple months shrinking territory. Richmond Fed manufacturing did dip down again to negative 11. So you're talking about 6 months now here. Sorry, 5 months in a row in negative territory. The Kansas City manufacturing and production index that did dip down as well from a positive territory in February. So the manufacturing sector, both in Richmond and Kansas City, certainly suffered, but the consumer isn't. Consumer sentiment rising to the highest levels since all the way back in 2021, when the government was still handing out a lot of checks. So definitely a lot of improvement there, and a lot has to do, I think, with the inflation ebbing to a major degree, although I'll show you in a minute, it's kind of flattening out at a elevated level. Total vehicle sales that did that did have a resurgence after a dip last month. So kind of in the 16 million range, which is a good market for cars, but not an amazing market, right? Pre-COVID, you were at closer to 17 million, but you're not at the depths of 2022 when this is at 13 million. So, we're almost back to pre-COVID levels. So it's a solid market for cars overall. Consumer, unemployment that did increase a bit. So you saw the initial claims for unemployment it remains subdued, but the continuing claims that did surge to the highest level in what since the almost since the beginning of the year. So the jobs market, although not bad, certainly continues to be incrementally weaker over time, and you see that with the unemployment rate approaching 4%, et cetera. Now, the big news was on Friday, the market was closed, but the PCE index came out, and year over year, that ticked up slightly. The 12-month trim mean PCE inflation rate, which is something a Fed looks at, that dipped down slightly, but still kind of at the 3% rate. And what you're seeing here is look at the slope of decline in inflation, and that's starting to level out on almost all of these indicators. If you go back to a 3-year chart, this is starting to level out in the 2.5%, 3% range, depending on what you're speaking about. But in general, this is an index that I think is going to allow the Fed, at least in the near term, to potentially cut rates. But I think as you go towards the back end of the year, that could change. And I do want to show you some charts on that in a minute, because it's very important to follow what commodities are doing. Commodities are definitely resurging. The personal spending that was up pretty nicely month over month, shows the consumer is relatively strong. And I want to show you this because Friday was that inflation number, and what you see is that the market for the June meeting is coalescing more and more around that one rate cut between now and June. It was 5% chance there'd be two rate cuts by June. Now it's only 2.6. It was going to be 55% chance that there would be one rate cut. Now it's 61, and 40% chance there was no rate cut, and 36% chance today. So the market's starting to really coalesce around, yeah, this is not going to be, the May meeting will not be one where the Fed cuts, but June is likely to be one, and that inflation data certainly back that up. Now let's get to the charts here. Here's the S&P. This is the end of the quarter. So, you go to a quarterly chart, pull up a quarterly chart. This is the end of the quarter, and we closed at an all-time high on the S&P. Now, if you move over to some of the other indices, here's the NYSE, same thing. You have the Nasdaq, uh, same thing. But you can see is it's not a great new high, right? And you see this MACD divergence here. Definitely the uh, the tech stocks are feeling less bullish. There is a MACD divergence on the S&P, but definitely stronger momentum there. And really, it's about this, which I show a lot, which is the growth to value ratio. And on a quarterly basis, this is the quarterly chart going all the way back to 2000. But this peaked in the third quarter of 2021, actually fourth quarter of 2021. We had the big reversal in the first quarter of 2022. And you've had that retrace over the past kind of 5 months where, sorry, 5 quarters, where I'll go to a daily chart here, where you saw growth start to outperform once again. Remember, this is the ratio. If growth is going up, growth is outperforming. It's going down, value is outperforming. And you saw that rollover to end the year, and then that resurgence to start the year. A lot of this had to do with options positioning. And January is the biggest month where option positions tend to roll off. There are gamma squeezes. A lot of things that disrupt the market or distort the market, excuse me, due to positioning. And as the year goes on, that becomes less of a problem, or less of a thing. And what you're seeing now is that trend that started at the end of the year is starting to reassert itself. So value over growth, and you're seeing that both in the near term charts as well as the long term charts as well. Now, I wanted to highlight this, which is the Dow Jones UBS commodity and Bloomberg Commodity Index, and that's starting to get some strength here, now above the 100-day moving average. It was weak for really the end of the year and the first couple of months of this year. What's interesting is that the dollar, here's the UP, that remains in an uptrend. It's been an uptrend pretty much since the start of the year, but commodities are getting a resurgence, and you're seeing that with oil. Here's USO. You're seeing that natural gas has been the weakest, that's for sure. But gold, look at gold, just surging. Same with silver, not as strong as gold, but definitely in an uptrend. The GDX is starting to really break out here and find some traction. So this is a time where money is moving into the harder assets. eh, this is the move index. The treasury market isn't a problem at the moment. So the Fed has, I think, some room to tighten policy. I think that could be a trigger for a potential market sell-off in April, especially with that inflation number kind of pausing, being a little bit hotter than expected. Um, and that's why I say, could there be a sell-off in April based on timing, the seasonality of the markets? Kind of the April to June timeframe tends to be a period where there is a bit more volatility. So um, it's not really showing up yet in things like the move index or the VIX, but I'll be watching that for a signal here coming up. And obviously, we don't have any market activity for Friday, and that was when you had the PC numbers. So it'll be interesting to see what happens there. Let's take a look at the credit markets. Credit markets. So here's short-term junk to short-term treasuries. And what's interesting is that we closed on a high in equities, but we did not close on a high in this ratio, short-term junk to short-term treasuries. And what it tells you is that, maybe the credit markets are starting to weaken a bit and pretend to a pullback in markets. And that's frankly what I continue to talk about is if you get one, and there's nothing that's telling you quite yet that this is ready, and you need some sort of breakdown. Frankly, my first level that I would say, okay, we're starting this market pullback is here. Right, we had the little pullback, and then you had a really breakout here, and this is the first wide-ranging bullish candle, and that was right about, it's called 5130 on the S&P. We're going to have to break below that for any traction to the downside. Now the cues you see here's that relative weakness. You had that surge up, and it's been kind of trailing off ever since. It's still near term bullish consolidation, but when you're have this at such a high level, where you're so far away from the moving averages, those bullish patterns can often fail, just because the larger patterns matter more. There are always micro patterns in the market, but you always want to look at the larger patterns because they matter much, much more. And you can see here at the MACD starting to weaken, momentum starting to weaken, etc. So, very interesting end of the quarter. I was expecting a little more weakness to close the quarter, but we didn't get it. And you can't really get ahead of this. You were here to call balls and strikes, and you want to be aware of potentialities, that could manifest in the charts and in price action, but you don't want to react too soon because the trend is your friend. And picking that exact time is, frankly, a fool's errand. You have to wait for the evidence to kind of stack up, and there's some mild evidence, but once again, price action is the major source of evidence, and you're not really seeing any issues on that front quite yet. But yeah, definitely want to be on the lookout as we look out for that, as we enter April. Now, the 10-year, that one did pull back a bit. We were flat on Thursday. But I still continue to believe the risk here is to the upside. And while it looks like you have this down move, this is effectively a bear flag. Uh, your inflation picture is likely to pick up in the back half of the year. And the market will start to front run that. Like I said, with look at what oil prices are doing, gold prices, copper prices. You can just look at like a Freeport, right, breaking out. The largest copper company in the world. So it's definitely a situation where near term, there's a lot of mixed. There's a big mixed picture. Um, Economic data is okay, but weakening. Inflation data is decelerating, but at a much slower pace, and in some instances, accelerating to the upside. Depends if you look at it year over year. If you're looking at 3-month annualized, 6-month annualized, that's increasing a bit. And so it's going to be much harder for the Fed to justify cutting rates if there is an acceleration to the upside in inflation. And like I said, that's likely to manifest more in the back half of the year as these higher commodity prices start to feed into the prices of goods and services throughout this quarter, and especially, like I said, into the third quarter. What are the sectors that are doing well? Energy, obviously, industrials doing well, and then financials. Financials continue to do well. Uh, Even the KBE, even the banking index, not amazing, but certainly in an uptrend. But you can see that compared to the broader financial sector, you definitely want to be in. If you're in the finance sector, the non-bank financials are certainly the ones that look the strongest, the healthiest, etc. So everyone likes to focus on banks. There's a lot of banks to go out there and invest in, but doesn't mean that you should be picking a ton of them up, because certainly there's some relative weakness there. What else do I want to get to? I think that's about it. In summary, you have to be neutral. Here's the IWV Russell 3000, 3000 largest stocks. You have to be bullish, right? Trend is your friend until it ends, and it has not ended. And I could sit here, as I argued, for reasons that there could be a market pullback, but you don't want to react quicker than you have to. Okay. So be patient, rebalance your portfolio, trim things that have relative weakness that maybe you're overweight in. Um, but the liquidity situation more broadly remains relatively robust. And you can see that mainly manifesting in the move index. The fact that this is moving down, right? I talked about, you have to go back to, let's go to a weekly chart on this. back when you had problems in the treasury market, this spiked up above the 140, 150 level. That's when you have problems. This is 86 now. Not really an issue. And frankly, we're in an election year, and the powers that be, they're going to do things to prevent a major crisis. And they're going to keep liquidity relatively robust. The treasury is going to issue on the short end of the curve versus the long end of the curve. That's been happening as well. And so these are all factors that line up to don't get too bearish. Okay. Um, just focus on a portfolio that makes sense for you, risk tolerance level, etc. All right. Appreciate y'all tuning in, liking, and subscribing to this channel. A reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.